Good morning and welcome.
Good morning. Thank you very much. Welcome.
Please, can I know your name again?
Sylvester. My name is Sylvester.
All right, Sylvester. Sylvester, welcome this morning.
Thank you very much.
I would like you to ask the question again before we kick off. What was your question?
I'm actually struggling with demand and supply. I don't really know which one is the correct one when I have to, look at the charts. But how to get them is my main problem, because sometimes when you see them in one time frame, it's different from another time frame. And, I know you explained to us that it depends on the kind of trading that we do. We have to stick to the time frames. Yes, but sometimes when I see the analysis, I see some people put analysis of 2 hours, then they go down to 30 minutes, they go to 15 minutes. It's always confusing for me to know exactly which one to start from. I've always wanted to follow your own strategy of 2 hours time frame, but all the 2 hours time frame and 4 hours time frame have been chosen. It takes a very long time for the price to return to the zone. And sometimes, because of the kind of work, like I explained to you, I use the Eastern Standard Time. It's really difficult. Maybe I'm asleep when the things happen. I'm really struggling to know which particular thing I should trade. I like Forex, but it's so difficult. It's mostly in the London time zone that all the action is happening.
Yeah, I understand. So, from your question, you're struggling to select the actual demand and supply zones to trade from. And
yes, that's my main problem.
Another thing is the time zones is actually hard for you.
Yes.
Okay, now this is what I would advise you should do in terms of the time zones before we start looking at the pairs and showing you how to identify the supply and demand levels. Now, talking about how to identify the right supply and demand zones, the thing is that you can't find the right 100%. You can't be 100% sure that price will actually react from that particular one you're choosing. Trading is a game of probability, and
yes,
we just play the probability. But we have rules which can actually help us select the right ones. Firstly, identifying the structure, and I guess you know how to read market structure.
Yes, I do.
Okay. Firstly, once you've been able to read the structure of the market, secondly, look for price inefficiency. That is fair value gaps. Look for the areas price left inefficiency, and that area price left inefficiency, the next thing you have to pay attention to is how price reacts to that level. Okay? Yes, how price moved out of the area, leaving that fair value gap. And that fair value gap that was left and how price reacts, it has to break structure, be it internal structure, external structure, or even a market structure shift. And I hope you understand all these things I'm mentioning.
Yes, I do.
Yeah, so after that, the next thing you need to pay attention is your liquidity areas. Liquidity areas will help you not to choose the levels which are kind of traps. Okay, your liquidity and inducement area, these are areas which are more like traps where you look to avoid trading. So these are just the ones I want to touch for now. Identify the structure of the market, the order flow, where price is moving to. Secondly, check if price left an inefficiency. Now, if price left an inefficiency and breaks structure with momentum, that's when you look to mark the supply or demand level below that price inefficiency. Then you look to see if liquidity was built. So if all these criteria are not met, then that supply and demand level is not the correct one, or is not valid. All these criteria has to be met before you choose. So let me do a quick sketch before we start looking for examples, and after now I will want you to share your screen. So you on your computer, right?
No, I'm on my phone.
Oh, I was thinking
my computer is not connected to.
Okay, I was thinking you were on your computer. I would have loved you to do some analysis yourself and try to identify some of these levels before we end this session, but it's all good. Let me just show you how to do it. Then after now, you can then practice and give me feedback.
Okay, I'll do that.
So firstly, understand the structure of the markets, how price is moving. So you already know that this is a bullish structure. Price is trending up. Whenever you see something like this, it means that price is trending up, right? Now, what you can see from here is that we've had the break of structure. That's the first one. We have the second break of structure right here. So now that you've identified that the structure is bullish, price is moving to the upside, what are you going to identify? Check if there is an inefficiency below here. If price leaves an inefficiency, this is where you're going to look to mark your demand level. Come over here to select your demand level. Mostly, I pay attention to the extreme levels most times.
The extreme levels, yes.
That's why I pay to look at the extreme levels. So make sure that there is an inefficiency and there is a valid break of structure. And the break of structure we're talking about, it doesn't have to be a spike. If price spikes above this level, then retraces back to close inside this range. That's not a valid break of structure. It has to close above this level. I hope you understand.
Okay, I get that.
It has to close above this level. Yes. So once it closes above this level, what else did I say you should pay attention to? Your liquidity inducement area. Then how price returns back to this level is actually very important. Okay. If price returns back correctively this way, then you can go ahead and look to enter this trade and look to trade to the upside. But if price returns back aggressively, you've seen price returning aggressively back into this level, there is possibility that this level could not hold price, because it's more like trying to catch a falling knife. Price is returning very fast, so there is a probability that it's not going to hold price. You will just want to see price return back correctively. Even if we see maybe price try to return aggressively, we had a little retracement, then returns back this way, it's a very good opportunity, because here could serve as an inducement area. Early buyers are going to anticipate that price is going to react from here when it's pushed to the upside the first time. Then this is the correct level you're going to look to mark, and you look to trade to the upside. Now, one thing you have to understand when looking at the price chart is that once price reacts to the upside, there is always a retracement, and that retracement, it might not really get to the demand level all the time. It might just retrace, maybe reach to 50% level and continue to the upside. So don't be disappointed when you mark your level and price couldn't get to your level. It's possible that price might react, come very close and move away to the upside. So when price does something like this, you can just go ahead and look for other opportunities. Okay, you can go ahead and look for other opportunities. Another thing I usually do when I'm looking at the price chart is that maybe price has come reacted from this level, and I see something like this. This is another area people get confused on the price chart. So the first level has been mitigated, and you see price react to the upside again. It has this break of structure, and at this point you'll be a little bit confused, because you might be seeing here as a demand level and this extreme level as another demand level. At this point you're thinking of which level should I choose. Then at this point, this is what you have to do. Measure with your Fibonacci tool. This is where your Fib tool comes into play, and it's not just about the Fib tool. Now, measuring with your Fib tool from the lowest point to the highest point of this level, you're going to see that this particular level is just slightly below the discount level. The low right here is the discount level, and the high is the premium level. And we usually sell from the premium level and we buy from the discount level. And you see, this particular zone is just slightly above this discount level, so you're not going to look to trade from this particular level, because price is very costly at this particular area. We look to do what? We look to buy low. When price is at a lower price, we look to buy, and when price is at a higher price, we look to sell. So at this point, price is still at a higher price. If price come back to this level, you don't look to buy, because price is still costly at this area. We look to sell when price maybe gets into a fair value gap at the discount level, or it totally mitigates the extreme level right here. And I hope you understand what I just explained. Now, that's not the only confluence you need. Sometimes you might actually mark this particular level, but there are inefficiencies below this level. So when there are inefficiencies below this level, we have the possibility that price could come back to maybe rebalance some inefficiency below here before reacting to the upside. So this is when we do see some of the liquidity sweep we have in the market. So the best thing I would advise you to do is to look at maybe the extreme level or any level below this particular one, and mark this particular area as your inducement area. And I hope you do see me mark my levels this way.
Yes.
That's why you see me. Most times people might ask me, why are you marking this level as an inducement area? This is the reason right here. But have it in mind that it's still possible that price will respect this your inducement area and react without coming back to your demand level. But to be on a safer side, choose the extreme level. And you know, the extreme level is usually the strongest, and expect price to come back and react. So this is the flip of it if you're looking for a supply level, right? It's just the opposite of it. And I don't know if you have any question from just the little thing that I've explained right here. Then we can I attend to that before we look at examples on the price charts.
Well, I get this. I get what you've explained to me very well. Thank you so much. I was getting confused with that one you just mentioned. That will fit too, but I get that now.
Okay. Now, another thing you have to understand is that nothing is 100% certain in the markets. I've explained to you that trading is about probability. So you could still choose your extreme levels, and the moment you choose your extreme level, that's when price will remember to shift in structure, and that's when we start looking for maybe lower prices. You understand? So at this point, maybe you've chosen to trade from this demand level. Now price shifted in structure, breaking below this level right here. So when you see that, this is when your bias will change. You start looking for your short opportunities. That when you start looking to trade from a supply level, right? So this
one question there, what you just said there.
Yeah.
Now, if you get your market structure shift that first time, don't you have to wait for the retracement and then for it to go back down again before you start looking for sales?
Now, this is based on personal preference. There are people who wait for price to come back, give them a retest to confirm it as a market structure shift. Some do wait for the retest. Then, when they have another break of structure, you see them coming to trade from the second level. Now, the way I trade mine, I said it's based on personal preference and based on what you've been experiencing in the market. From what I've experienced in the markets over time, I don't wait for the second one. I approach the market from the first one. Yeah. So it's now left for you after this lesson during your back test. You pay attention to both the first and the second one and see the one which gives you good results over time. And you pay attention to that particular one. Okay. So let's see a live chart example, and we're actually on NASDAQ. I'm using NASDAQ because we've had series of good price actions on NASDAQ right here. So this is NASDAQ the 2 hours time frame, and let's start from this area. From this particular area, just like I've always said, try to identify the structure of the market. So from what you can see from here, price trended to the upside, retraced to the downside. Here is another move to the upside, and we have this shift right here. This is a shift in market structure, right? And if you're actually looking to trade, just like the last question you asked, where I said price shifted in structure, because although this demand level right here is not totally valid, but I can see some inefficiencies right here. I hope you can see some inefficiencies. So someone might actually include this level right here as his demand level, and if you try to extend, you see how price returns nicely, mitigates, and we have good reaction to the upside. Now price is reacting to the downside because from what you can see, this was a break of structure and this was a market structure shift right here. You see that? Because we had a little retracement. This is just a little retracement and price shifted the structure from there. Now price is currently reacting from this fair value gap, and just like I said, it might not always get to your demand level because you see price couldn't get to this particular demand level right here, and it traced to the downside. So when we had that shift, if I was actually paying attention, I won't even look to trade from this level because here is going to serve as my inducement area. Now the supply level we have right here, this is actually supply level. If you try to extend, you see price just came a little reaction and it failed. So this is where that question comes in, if I have to wait for a double confirmation or would I approach during the first shift. So if I was actually paying attention to NASDAQ at this particular point, I would have lost money on this particular setup because I don't wait for double confirmation. And you see this shift in market structure couldn't hold price. You see price continue trending to the upside. So if I approach the market here, I lost money on this setup, and it's totally understandable for me because that's the way I approach the market, and I won't actually blame myself because this is part of my rules. This is the way I do it, and it's have given me results a lot of time in the market. So if this one fails, I don't have to panic because I believe next time I will still have good results trading this method. So this is the way you should organize your mind, and this is the way you should think because nothing is certain in the market, right? Then from this particular area, this was the low, reacted to the upside, comes back again, for a mitigation, but this was not a valid setup. Price came back at the extreme level, respected it, and reacted to the upside. We have another break of structure. So this level was not valid. Why is it not valid? Firstly, we had a break of structure, nice. We have an inducement area, nice. We have a demand level, but no price inefficiency.
Fair value gap.
Yeah, no fair value gap. So it wasn't a valid one. It's just reacted to the upside. And now we don't have a valid break of structure right here, because this looks more like a spike. Okay, I can clearly see, okay, price finally closed above this particular high before it retraced back into this level. So if you were looking at a demand level right here, you wanted to mark a demand level, this is the right one to select right here, because this one left inefficiency. I hope you can see that there is price inefficiency, and price closed above the high, barely closed above the high actually, then it retraced back, then spiked a little bit below this level. So this is where you have to pay attention to how many pips you add underneath your zones, because if you added few pips, you wouldn't have gotten out of this trade. And I believe if you entered this trade, you would have gotten at least even if it's 1:2, you would have made a little money from this setup. Let me see, you see almost 1:3 from this particular setup. So it was a good one. Then you see price comes back to sweep the liquidity at this particular low. You see that liquidity sweep before price reacted to the upside. And finally, let's just pay attention to the external structure and leave what is happening at the internal structure. So let me delete this. So price swept the liquidity at the low. This is an old low. Price swept the liquidity, offered price action more like the turtle soup, come for the retest. Then from here it retraced to the upside to take the external range liquidity. And this particular setup was shared to the community when we had it on our list. So what you can clearly see from here is that this particular one met the criteria. First, price reacted with an institutional candle. You see this candle has momentum to the upside, a break of structure. And now these are demand level, fair value gap here, price inefficiency, and inducement area. It met the criteria. Then this is the right zone to trade, and you see it's already marked up. Now price came for the mitigation, and after the mitigation we had good reaction to the upside. I hope you can clearly see that. Yeah, so that's it. But before that, you can clearly see we had a shift right here. You see we have a shift right here on the 2 hours time frame, and this is the details you have to pay attention to while looking at the price charts. You see price break above the high. You have this single candle pullback, another break above the high, then retraced back, and we have this shift in market structure right there. I hope you can see that we had this shift. But
one question. This single candle pullback, do we still look at it as a valid pullback?
Yeah, when we talked about pullbacks, I could remember when we had a session on pullbacks, I said most times I consider single candle pullbacks, but it depends on the candle. Now I said it depends on the size of the candle. Now you see this candle right here, this particular one right here.
Yes,
it's very small. I can't consider this as a single candle pullback. But you see this one we have right here.
Yes,
I considered it. Why? The size of the candle. The candle is very large.
It has to do with the time frame as well. If you go to a lower time frame,
if you go to a lower time frame, this might be a very valid one. But based on the time frame I was looking at the moment, this is not valid. But this particular one is valid. Another reason why I chose this particular one as a valid single candle pullback is firstly, external range liquidity was taken, and yeah, and we have this single candle pullback, a reaction to the upside, and we have a shift immediately. So this is about confluence. I'm adding this as a confluence because once price takes external range liquidity, we usually expect a pullback, and we were actually seeing a pullback immediately the external range liquidity was taken. So I was already anticipating a reversal from this level. I hope you can see that.
Yes.
So marking your level right here is not a bad one, because you see price came back for mitigation and a reaction to the downside, because if you look closely, there is price inefficiency right here. We have inducement areas, these levels before the mitigation. You see that, and after that we have a reaction to the downside which breaks structure. Now I wasn't going to choose any level from here because there is no price inefficiency. Price was efficient at this level, and at this point same thing, price was efficient, and no need to look for any level right here because price was efficient. But talking about break of structure, price broke structure to the downside, but I wasn't going to trade from any level, no price inefficiency. And I hope you're actually understanding exactly what I'm explaining.
Yes, I'm understanding.
So
thank you.
from here, you see price reacted to the downside again. So if I was actually looking at this level, looking for where to trade from, I would have paid attention maybe to this particular level right here. But most times I like looking at the extreme level. So the extreme level which I love looking at was efficient. So me knowing that here is an inducement area, I won't look to trade from here. Although price reacted with momentum from there to the downside, this is the inducement area. I would have loved to pay attention to the extreme level, but no pricing efficiency, so I won't look to trade from here at all. Then we had a break of structure from this level. Price moved with momentum and it breaks internal structure. See, price breaks this structure right here. Then this is the point of interest. I could remember one of us in the community, he got an entry from here. He looked to mark from this particular level. He looked to trade from here. Then at first, you see all the criteria were met. What are the criteria? Institutional candle that breaks structure. You see it broke structure. Yes. Secondly, pricing efficiency, we have that. Then we have our level. You see how price comes back to mitigate it after it's moved above this liquidity area, because this is more like a trend line liquidity area. Price comes back for the mitigation. We have that first reaction to the downside. It came back once more, and this was the moment NASDAQ shifted in structure and started to trend to the downside. Hope you can see that. Yeah. Now at this point, this is another area which we paid attention to at first. This was where we had a market structure shift. And why didn't I look to, because I wanted to share this level for us to look to trade from this level, but I didn't do that. Why? This market structure shift was not valid for me because price didn't close underneath this level. It was just a spike and price retraced back into this level. So when I marked this particular area looking to trade from here, I didn't share it to the community because it wasn't a valid setup for me. It wasn't valid. This is where we confirmed the market structure shift at this particular level when price came back to mitigate the level and we have a fresh breakout structure. So this was where it was confirmed that we were shifting in structure. Then this was the setup I shared. We have a liquidity sweep and we have this momentum push to the upside which breaks structure. These are inducement area. We have a lot of pricing efficiency, so we marked our level. And from what you can see right here, price came back, mitigate our level the first time. This is a news event. Price retraced back. Then you see the reaction from there. If you try to zoom out from there, you see price has been trending to the upside because it was a valid market structure shift. This was where it was confirmed. And I hope you're actually getting exactly what I'm explaining. So after this particular setup, we had the second one right here, which we are looking to trade from, but unfortunately price didn't come back. Now let's look at the criteria. Firstly, institutional candle that breaks structure, right? Secondly, we have pricing efficiency. You can clearly see that we have a lot of inefficiencies right here. Thirdly, we have our inducement area. Then we have our level. And you see this particular candle was able to sweep liquidity underneath this low. So this was a valid level, but just like I said, price didn't come back to mitigate the level and price moved away from there. So this was another analysis we had right here, and this particular analysis, it was not also shared. Why was it not shared? Firstly, I think during the live session we talked about it, but I didn't share the analysis because price only swept the liquidity underneath this level. It wasn't a valid break of structure. Yeah, if price closed underneath this low, I would have shared the analysis because at first we have that institutional candle to the downside, but unfortunately it didn't close underneath this low. We have the inducement area because you can see this now equal highs. You can see that, and if you look, we still have price inefficiency in here before we see this mitigation right here and that reaction to the downside. So this is it about how to select your supply and demand levels. And I can't tell that this is the best way to select it because this is the way I approach the market. Just like I said, I wish you were on your laptop. I would have loved us to go to a different pair, and I ask you to do it yourself. Let me see if you actually understand what to do. But anyways, it's still good. Maybe you can review. If you want this lesson later, I can send it to you. Then you can,
I would really appreciate that.
Yeah,
I really appreciate
I can
that.
send it to you so you can rewatch it and then you practice and give me your feedback.
Yeah, thank you so much.
No, I want
really
now. All right, now I want to ask: can I share this lesson on YouTube? Like maybe later I can just share to YouTube so others can learn from it.
Yeah, that's fine.
Okay, I can do that.
Yeah.
All right. Thank you very much.
Thank you very much. I really appreciate this time you took to share this with me.
All right.
I really, really do appreciate that. I have a better understanding now
All
of
right.
this. I will go through it again, make it sink in. Thank you so much.
All right. Thank you very much. Now I want to ask, hope you'll be joining our live session today.
Yes, by the because today is Sunday. Yes, I will do it today.
All right. Okay. Thank you very much. Thanks for your time.
Thank you. Thank you.
So this
You're
is
welcome.
this is the end of
Thank you,
today's.
sir.
All right.
Yeah. Bye bye.